Greetings, everybody. Welcome to Liberty Call. It is Wednesday, November 30th, 2022. I hope everybody's having a fantastical day out there. Last day of November, headed into the home stretch for the year with December tomorrow and, Christmas and all that good stuff coming up. So, again, hope everybody's having a good end of the year. Markets definitely took off this afternoon, if you're wondering why. The god of interest rates, Jerome Powell, put out some hints that there may be some slowdowns in the rate hikes that are coming up here in the near future. I personally would like to see rates go up faster. I'd like to get this inflation under control sooner than later. My fear is that if they take their foot off the gas too early, then we're just going to have a rebound effect. Again, I've used the example of, if you stop taking your medicine too soon and then you wind up getting sick again, it's kind of the same old, but the markets seem to react pretty well to it. So let's go ahead and dive in and look at the numbers and see how things did today. The Dow Jones was up 2.18%, over 736 points, closed at 34,589. The S&P 500 was up 3.02%, closed at 4077. NASDAQ was up 4.41%. It was the one the one major index that was in the green all day for the most part. And I'll bring up the chart. Actually, let me bring it up right now. Yeah, because here's the S&P 500, and let's go to the minutes. And you can see here's today. Started right here, was kind of down most of the day, down about a third of a percent, and then right about 1:30-ish Eastern time, it just took off. Same thing with the Dow Jones, and like I said, the Nasdaq was above treading water. It did dip a little bit here for a stretch, but yeah, it was definitely. I was sitting here looking at the market or at the charts, and I'm like, what is going on? All right, getting back to the numbers, small caps are up 2.41. The VIX fell 6.3%. It's currently at 2051. Canada was up 0.87. Brazil was up 1.08%. Mexico was up 3%. Over in Europe, Germany was up 0.29. UK up 0.81. France up 1.04%. The Euro Stoxx was up 0.77. Netherlands was up 0.89. Spain flat. Italy up 0.59. Switzerland up 0.45. And Portugal up 0.55. In Russia, the MOEX was down 0.49. The RTSI was down 0.32. And the Asian markets overnight, Japan was down again today, down 0.21. Australia was up 0.43. New Zealand was up 1.38. Let's see here. The Chinese markets, the Shanghai was up barely by 0.05. The SESE component up 0.18. The China A50 up 0.35. DJ Shanghai down slightly at 0.04%. The Hang Seng up 2.16, and the Taiwan weighted came in up 1.16. So yesterday was the Chinese markets that really exploded, and I was wondering if how they would do today, but it looks like they held on to most of their gains. I mean, the Shanghai was down slightly, but again, nothing too terrible there. So. All right, well, let's take a peek at the market recap for today and see what they had to say. Wall Street rallies after Powell eyes slower rate hikes. Wall Street jumped Wednesday after Federal Reserve Chair Jerome Powell said that the central bank might scale back its pace of interest rate hikes as soon as December. That's tomorrow, or in the next month, starting tomorrow. The S&P 500 rallied from an earlier loss, and the NASDAQ extended gains after the release of Powell's remarks prepared for delivery at the Brookings Institute think tank in Washington. Powell also cautioned that the fight against inflation was far from over and that key questions remain unanswered, including how high rates will ultimately need to rise and for how long. Quote, the market has waited with bated breath looking for that clarification in terms of duration and to extent of Fed tightening. And anything that gives hope to the idea that the Fed is becoming less hawkish is viewed as a positive for stocks, at least on the short-term basis, end quote, said Chuck Carlson, Chief Executive Officer at Horizon Investment Services. Bets that the Fed will reduce the size of its rate hikes, as well as the recent data pointing to a mild cooling in inflation, have the benchmark S&P 500 index on track for its second straight month of gains. The CME FedWatch tool showed futures traders seeing a 75% chance that the Fed will raise interest rates by 50 basis points at its December meeting, up from 65% chance before Powell's comments were released. The FedWatch tool now shows a 25% chance of a 75 basis point increase. Personally, I like to see them go up by a whole percent till we get up to about 6 or 7% and get the inflation number below the actual rates. But again, these chicken people are not in a hurry to do that. The S&P 500 remains down by about 16% so far in 2022, while the NASDAQ index is down or has lost about 29% for the year. In afternoon trading, Apple was up about 3.4%, and NVIDIA jumped 5.5%. Tesla Inc. shares surged 5.4% after China's Merchants Bank International said Tesla's sales in China in November were boosted by price cuts and incentives offered on its Model 3 and Model Y. Data on the day was mixed as the ADP employment report showed private employment increased by 127,000 in November, below expectations of 200,000 jobs, suggesting demand for labor was cooling amid high interest rates. Quote, the ADP employment number not meeting expectation fits into the narrative that the Fed will have room and start slowing down its rate hikes, and that definitely benefits interest rate sensitive assets, in quote, said Keith Buckingham, portfolio manager at Globalt. The Labor Department closely watched non-farm payrolls data is due on Friday. A report showed U.S. job openings falling to 10.334 million in October against 10.687 million in the prior month. So, all right, so that's everything as far as the recap of the markets. Let's dive a little deeper into Powell's remarks and see what's in there. Powell tees up slower growth in December hike, but says still way to go until peak rates. Federal Reserve Chairman Jerome Powell said Wednesday that the pace of rate hikes is likely to slow, but the peak level of rate hikes will be higher than previously expected as there's a long way to go to curb above trend inflation. Quote, moderating the pace of rates increases may come as soon as the December meeting, end quote, Powell said in a speech on Wednesday at the Brookings Institute event in Washington. He added that the Fed's monetary policy was approaching, quote, the level of restraint that will be sufficient to bring inflation down, end quote. The Fed chairman, however, pushed back against market bets for a sooner rather than later pause on rate hikes, saying that the peak level of rates or the terminal rate will need to be, quote, somewhat higher than thought at the time of the September meeting and summary of economic projections, end quote. So again, I think they're going to go higher than 6, somewhere 6 to 7. But a lot of people are like, 4 to 5, maybe 5 to 6. But again, I think it's going to take a lot, a bit higher than what the financial journalists and the people out there who want to get growth stocks back on track, because growth stocks don't do well with high interest rates. They typically do much better as far as their valuations when interest rates are at rock bottom. So I think that's what a lot of people want to see. About 70% of traders expect the Fed to slow rate hikes to 50 basis points in December, down from 75 basis points seen in the prior 4 Fed meetings. Quote, we continue to expect the FOMC to slow the pace of rate hikes to 50 basis points in December and to 25 basis points in February, March, and May, raising the Fed funds rate peak to 5 to 5.25%, Goldman Sachs said in a note ahead of Powell's remarks. So again, I think they're being a little too optimistic that they're going to that the rate hikes are going to end sooner than later. But again, I could be wrong. I'm not perfect. All right, well, let's read into the jobs data. U.S. job openings fall in October. Labor market is still tight. U.S. job openings decreased in October, but remain significantly high, pointing to continued labor market resilience despite the Federal Reserve's efforts to cool demand by aggressively raising interest rates. The tight labor market keeps the Fed on course to continue tightening monetary policy, heightening the risks of a recession next year. Come on. Personally, I think we're kind of already in some sort of a slow recession as it stands, really all year. But again, they can hold on to hope that they can avoid it and have that soft landing they keep talking about. Most economists, however, believe any downturn will be likely short and mild because of the unprecedented job market strength. Job openings, a measure of labor demand, decreased 353,000 to 10.3 million on the last day of October. The Labor Department said in its monthly job openings and labor turnover survey, or JOLTS report, it was the 16th straight month that job openings remained above 10 million. October's job openings were in line with economists' expectations. There were 1.7 job openings for every unemployed person in October, down from 1.9 in September. Last month's decrease in job openings was led by state and local government, excluding education, where vacancies dropped by 101,000. There were 95,000 fewer job openings in non-durable goods manufacturing, while federal government vacancies fell by 61,000. But there were 76,000 additional job openings in other services, and unfilled positions increased by 70,000 in finance and insurance industry. The job openings rate fell to 6.3% from 6.5% in September. Hiring slipped to 6 million from 6.1 million in September. Mounting recession fears appear to have taken some of the steam out of the Great Resignation movement. About 4 million people quit their jobs. About 4 million people quit their jobs, down from 4.1 million in September. The quits rate, viewed by policymakers and economists as a measure of job market confidence, fell to 2.6% from 2.7% the prior month. Layoffs increased to a still low 1.4 million from 1.3 million, leaving the layoffs rate unchanged at 0.9%. Quote, the data suggests only very little loosening in the labor market so far, in quote, said Isfar Munir, an economist at Citigroup in New York. Quote, it will be difficult for the Fed to be anything but hawkish at the moment, end quote. So that's kind of an opposite view of everyone else out there. So again, the job market's pretty tight. There's still plenty of jobs out there for those who actually want to earn a living. Or if you just want to live off the government, that's fine. I don't mind paying for it. All right, one last article here. Some bad news from Bank of America. Stock market could plunge another 24% next year, Bank of America warns. Woo. I mean, this doesn't surprise me. I could see it going even further than that, but those are my own personal predictions. The stock market is not out of the woods yet and could face another further volatility next year as a result of the Federal Reserve's quantitative tightening, according to Bank of America strategists. In an analyst note this week, the analysts led by Savita Subramanian warned that the Fed's shrinking of its balance sheet could fuel liquidity risk in different areas of the market. Bank of America projected a best-case scenario of flat returns in 2023, with the S&P finishing the year at 4,000, up just 0.9% from Monday's close. But it warned of major volatility in the market throughout the year and said that its so-called bear case scenario, the S&P benchmark index, could tumble another 24% from current levels to about 3,000. Was there anything else there? Yeah, that was about it. Here they just go through the, as far as things we've already talked about till we've been blue in the face, as far as the government, central bank, taking assets or selling off assets off its balance sheet at $95 billion per month, which, they've been doing that very, very slowly. So unwinding the balance sheet, and then the rate hikes that have been going on. So, all right. So again, not great news out there. Bank of America sees that things could get a lot worse. Again, I don't think that's outside the realm of possibility, and we'll see what happens after the first of the year. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And if anyone needs anything from me, they can send me an email, drop me a phone call, or you can send a note and book a meeting. All right. Well, that's everything I had. I hope everyone has a great night. Now I'll talk to you next time. Adios.